Thank you for joining me. I'm Alex, and I would like to talk to you about how to value stocks. And this is the basics of what Warren Buffett does, and by extension, Benjamin Graham before him. And it's way more complicated than that the deeper you get into it. But there's two fundamentals that you need to keep in mind whenever you value stocks, whenever you decide which stock to invest in. And these are safety of principal. How likely are you to lose money on the stock, basically? So you're always striving to have the safest investments possible, because losing money hurts you so much more than making money helps you. And what I mean by that is, if you at any year lose 50% of your investments, you need to have a gain of 100% the next year to be back to where you started. So losing money is always extremely bad, and much worse than making money is good, if that makes sense. So the second one is the return on investment. How much money are you making with whatever money you're investing? And that comes in two forms. One is the dividends, which not all stocks pay. And one is the growth, which also not all stocks have. And then at that point, you need to weigh one against the other. And what I mean by that is, fundamentally, the safer an investment is, the higher its price compared to the earnings that you can achieve. So let's say you have a company like Walmart. Walmart is extremely safe to invest in because it's been around for 50 years. It's going to be around because it has stores in every city in America. There's no fundamental threats against Walmart's business model. They keep doing things extremely well. They have great management. Walmart is just not going to disappear from one year to the next. On the other hand, you have a company like, let's say, Enron or WorldCom or whatever you want to have there. Or let's take a company like MySpace, right? So they were a growing social network. They were doing things right. They were the first in the business. And basically from one day to the next, they just disappeared. So obviously, you need to make sure that what you're investing in is safe, or at least safe enough. And then you decide on what the income is that you can generate. And you need to weigh the income against the safety, but you always need to have a threshold of how safe you're comfortable with. And in the most extreme case, we have the lottery, with a near certainty that you're going to lose all of your investment. But the upside is fairly big. Now, that only holds true with fairly small investments, but you get the point there. So, again, going back to Walmart, you have extremely safe principal, you have dividends, and you have growth. Now, the growth is fairly small because the company is one of the biggest in the world, but the dividends kind of offset a lot of the initial return on investment. And if you swing all the way to the safe side, you have the US government bonds, which currently pay just a touch over 2% per year. And you realize that Walmart, because of the dividends, already pays slightly better return than US government bonds. Now, they're obviously slightly less safe, but they also provide growth. So all this is the fundamental of how Warren Buffett values stocks. You judge the safety of principal, the return on investment, and compare that to an extremely safe investment form like US government bonds, which kind of provide a baseline of what you can judge everything against. And if you don't want that as a baseline, you can use the inflation as a baseline. But basically, you have a baseline of the extremely safe investment that you could just invest all of your money in. And then you kind of go from there and see if whatever you're trying to invest in is as safe and provides as much return on investment. And so that's what you need to do for every single stock that you invest in. If you like more videos like this, make sure to subscribe if you haven't already. I hope you have a successful day.